In January 2024, independent journalist Whitney Webb made a prediction during an interview on the TFTC podcast that, at the time, sounded extreme to most listeners. She argued that another major financial crisis was not only inevitable but, when it arrived, would likely be used as an opportunity to fundamentally reshape the global financial system. Her exact words were, "Another banking crisis and economic calamity is inevitable. And you don't want to be blamed by people when they're angry about their money not really having value anymore. So how do you get around that? You create a crisis, relaunch the financial system, and suddenly you know who everybody is. Because there's this parallel push to end online anonymity and financial privacy. That's part of this whole narrative about Bitcoin financing terror transactions." At the time, those comments were interpreted by many as speculation about some distant future scenario, possibly another banking panic or a recession similar to 2008 or 2020. There was no obvious trigger on the horizon that would force governments into the kind of emergency response she was describing. Markets were relatively stable, global trade was functioning normally, and although debt levels were high, there was no immediate crisis that appeared capable of forcing the kind of systemic reset she was warning about. Today, that context has changed dramatically. The world is now 2 weeks into a full-scale regional war involving Iran, the United States, Israel, and multiple Gulf states. Oil prices have surged above $100 per barrel after the Strait of Hormuz was effectively closed to commercial shipping, cutting off a waterway that carries roughly 1/5 of the world's daily oil supply. Global stock markets have fallen sharply, recession probabilities have risen across prediction markets and institutional forecasts, and governments around the world are already preparing emergency spending measures to stabilize their economies. In other words, the type of crisis Webb described in 2024 is now unfolding in real time. If you follow geopolitics, financial markets, or Bitcoin, this is the kind of moment you cannot afford to misunderstand. Subscribe to the channel and turn on notifications, because we are not just reacting to headlines here. We are breaking down the deeper forces behind them. Thanks, and let's dive right in. When the first strikes were reported and the risk of a regional war became clear, the consensus assumption across financial media was that Bitcoin would fall along with other risk assets. Historically, major geopolitical shocks have triggered short-term liquidations across equities, commodities, and cryptocurrencies as investors rush toward cash and government bonds. Yet this time, the opposite has happened. Bitcoin briefly touched $74,000 on Friday, breaking a multi-month downtrend even as global markets showed signs of stress. That divergence has forced analysts to ask a deeper question. Why is Bitcoin holding strength during a moment that should, in theory, be extremely negative for speculative assets? To understand why this is happening, it is necessary to examine some important and brutal warnings Whitney Webb has issued over the years about this very moment. Her argument has never been that crises are random events. Instead, she has consistently argued that periods of instability are often used to justify policies that would otherwise face political resistance, including large-scale monetary expansion, increased financial surveillance, and structural changes to the global banking system. This means the current war does not simply represent a geopolitical conflict, it represents a catalyst that could accelerate trends already underway in the financial system. And if that interpretation is correct, then Bitcoin's resilience during this crisis is not surprising at all. It may be the clearest signal yet that markets are beginning to anticipate what comes next. Let's begin by examining Webb's concerns about the financial reality of war itself. Modern warfare is extraordinarily expensive, not only because of the cost of weapons and personnel, but because of the economic disruptions that follow when energy supplies are threatened and global trade becomes unstable. The current conflict has already required the deployment of aircraft carrier groups, missile defense systems, and thousands of troops across the Middle East, while U.S. allies in the region are intercepting drones and missiles on a daily basis. Each interceptor can cost millions of dollars, and sustained operations quickly add up to tens of billions in spending even before the broader economic consequences are considered. Those broader consequences are now becoming visible through the oil market. With the Strait of Hormuz restricted and shipping insurance costs rising, crude prices have surged past levels that historically place enormous pressure on governments to intervene. Higher oil prices do not only affect gasoline. They raise transportation costs, increase food prices, push up heating and electricity bills, and feed directly into inflation across the entire economy. When that happens during a period of military conflict, political leaders face pressure from both voters and markets to provide relief. subsidies, emergency spending packages, and support for affected industries become almost unavoidable. This is exactly the scenario Webb was describing when she warned that the next crisis could lead to stimulus on a scale far larger than anything seen during COVID. In the same 2024 interview, she stated that the next round of monetary expansion might not be measured in trillions, but in tens of trillions. Her exact words were, "If there is another lockdown or any of these things that we all basically are just waiting for to happen again, there's going to be massive stimulus, and the next stimulus is not going to be $5 trillion or $6 trillion. It's going to be 40 trillion, 50 trillion. We're going to see really extreme stuff." Governments are now entering crises with far higher debt levels than in previous cycles. The United States alone carries more than $34 trillion in federal debt, while Europe and Japan are refinancing record amounts of sovereign bonds. When a war disrupts global energy supply on top of those existing obligations, the ability to fund spending through normal taxation becomes limited, almost impossible. Historically, the gap has always been filled the same way, through monetary expansion, often described more politely as liquidity support. For Bitcoin investors, this dynamic has always been one of the most important drivers of long-term price trends. Every major bull market in Bitcoin's history has coincided with periods when central banks expanded their balance sheets and governments increased deficit spending. The reason is not mysterious. When more currency is created to finance debt, the relative scarcity of assets with fixed supply becomes more valuable. Gold has reacted this way for decades, and Bitcoin, with its strictly limited issuance schedule, has shown an even stronger sensitivity to changes in global liquidity. If the current conflict forces governments to spend at the scale many analysts now expect, the structural effect on Bitcoin over the next several years could be profoundly bullish, regardless of short-term volatility. If this connection between war, debt, and money printing makes sense to you, hit the like button so more people see this, because most investors are still looking at this conflict only from the surface level. And I'm curious where you stand on this. Do you think this war ends with tighter policy and recession? Or do you think governments will do what they have always done and print their way out of the problem again? Webb's analysis goes beyond monetary policy and focuses on how crises are used to justify changes in the structure of the financial system itself. In multiple interviews and presentations, she has argued that periods of instability often create political conditions where governments can introduce new forms of surveillance, regulation, and centralized control that would be difficult to pass during normal times. In her 2023 presentation on the future of financial privacy, Webb said, "The fight over the control of the cryptocurrency space is part of the larger war being fought over the future of our society, our country, and the world. Whether we realize it or not, a struggle is underway. A struggle over who will control the next generation of money, who will shape financial policies, and decide what the global monetary system looks like for decades to come, and powers are fighting tooth and nail to win." This struggle becomes most visible during moments when security concerns dominate public debate. The current war exemplifies this pattern in several ways. As sanctions expand and governments attempt to restrict financial flows connected to the conflict, regulators are once again discussing tighter monitoring of digital assets. The familiar narrative that cryptocurrencies could be used to finance terrorism or evade sanctions has returned to headlines, even though the actual data shows that the vast majority of illicit finance still occurs through traditional banking channels. Nevertheless, the perception of risk allows policymakers to argue for more reporting requirements, stronger identity verification rules, and closer integration between financial institutions and government agencies. At the same time, central banks continue to explore central bank digital currencies and other forms of programmable money that would allow transactions to be tracked in real time. Supporters of these systems argue that they improve efficiency and security, but critics, including Webb, have warned that they could also reduce financial privacy and give authorities unprecedented visibility into economic activity. When these proposals are introduced during a period of war or economic instability, they can be framed as necessary tools for maintaining order rather than as controversial reforms. This creates a paradox that is highly relevant for Bitcoin. The more the traditional financial system moves towards centralized monitoring and control, the more attractive a decentralized alternative becomes for those who want an asset that cannot be frozen, censored, or inflated at will. In that sense, the same events that increase pressure for regulation can also increase demand for a system designed to operate outside of it. Bitcoin's ability to hold its value during the current conflict suggests that at least part of the market understands this dynamic and is positioning accordingly. Now let's examine the impact on market behavior itself. One of the most telling signals during the current conflict has been the difference between retail sentiment and institutional activity. Retail investors tend to react emotionally to headlines, selling risk assets when uncertainty rises. Institutional investors, by contrast, often look further ahead and focus on how policy responses to a crisis will affect liquidity and asset prices over time. Recent data suggests that while sentiment has turned cautious, large buyers have not disappeared from the market. Large corporate and institutional purchases have continued even as geopolitical risk increased, and exchange-traded funds holding Bitcoin have seen relatively modest outflows compared with previous periods of stress. Funding rates in derivatives markets have remained negative for an unusually long stretch, a pattern that historically appears near local bottoms when traders are positioned for declines that never fully materialize. These signals do not guarantee that prices will rise immediately, but they indicate that the market is not behaving as it typically does during a panic. Instead of a broad liquidation, there appears to be a gradual transfer of coins from weaker hands to stronger ones. From Webb's perspective, this makes sense if investors believe the current crisis will eventually lead to another wave of monetary expansion. If governments respond to the war with higher spending, subsidies, and liquidity support, then the long-term environment becomes similar to the one that followed the 2020 stimulus programs, when Bitcoin entered its strongest bull market to date. In that scenario, the conflict itself is not the event that drives prices higher. The policy response to the conflict is what matters because it changes the supply of money relative to the supply of scarce assets. Now, let's take a little step backwards. Despite the bullish long-term implications, there is still a clear short-term risk that investors cannot ignore. The Federal Reserve's upcoming meeting will be the first opportunity for policymakers to respond formally to the economic impact of the war and the surge in energy prices. If inflation rises because of higher oil costs, the Fed may be forced to delay rate cuts or signal tighter policy than markets expect. Historically, Bitcoin has often sold off immediately after Federal Reserve meetings, not because the long-term outlook changes, but because traders adjust positions based on interest rate expectations. A similar reaction would not be unusual this time, especially given how sensitive markets are to any change in liquidity conditions. However, Webb's broader argument suggests that focusing only on the next few weeks may miss the larger pattern. Wars increase government spending. Higher spending increases debt. Rising debt eventually forces central banks to provide liquidity, whether through direct asset purchases, lower interest rates, or other forms of support. Each step in that chain has historically pushed investors toward assets that cannot be created at will. In previous decades, that meant gold. In the current cycle, it increasingly means Bitcoin as well. For that reason, the most important question is not whether Bitcoin experiences volatility during the next Federal Reserve meeting or the next escalation in the conflict. The more important question is whether the structural forces Webb has been describing for years are now accelerating. If this war leads to the kind of large-scale stimulus, financial restructuring, and expansion of monetary supply that she warned about, then the conditions that have driven every major Bitcoin rally in the past could be returning once again. In that context, the current moment does not look like the beginning of a collapse. It looks like the early stage of another cycle in which crisis leads to liquidity, liquidity leads to asset inflation, and scarce assets benefit the most. That possibility does not eliminate risk, but it explains why Bitcoin's behavior during this war has been so different from what most investors expected. I want to hear your view after everything we discussed. Do you think this war becomes the trigger for another massive wave of money printing? Or do you think this time governments will try to tighten control instead of expanding liquidity? If you found this analysis valuable, subscribe to the channel and stay with us, because the next few months could decide the direction of the entire financial cycle, not just for Bitcoin but for the global system itself. Thanks for watching, and see you in the next one.